You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Imperial Brands, Vodafone, Burberry, Hotel Chocolat, BAE, and our US company of the week is PayPal. Sam, shall I kick us off with Imperial Brands?
Absolutely. How are they doing?
Well, pretty much same as last time, but Imperial Brands, we've covered it a lot of times on the show. It's the UK's second largest tobacco company, owner of brands like Lambert & Butler and Players. They had their full year results out last week with full year net revenue growth of 1.4% to £8 billion, ignoring the effect of exchange rates. And this also excludes the impact from the Imperial's exit from the Russia operation. Growth was entirely driven by higher prices, which were up 11%, and this offset a 7.1% decline in tobacco volumes and a shift in the United States towards lower value brands. Next generation products saw net revenue growth of 26.4%, driven by a 40.4% uplift in Europe, and improved revenue together with cost control helped underlying operating profit grow 3.9% to £3.9 billion. Imperial generated free cash flow of £2.4 billion compared with £2.6 billion last year, and net debt was flat at £8.4 billion. The new financial year, the group expects revenue to grow in the low single digits and operating profits growth in the mid-single digit range. Performance will be weighted towards the second half of the year. The dividend was increased by 4% to 146.82 pence per share, and the group confirmed plans for a £1.1 billion share buyback following the £1 billion share buyback last year. And the group chief executive, Stefan Bomhard, pointed out the group would have returned £2.4 billion to shareholders this year, which is equivalent to about 15% of its market cap. And over 4 years, to the end of next September, the group would have returned around £7.3 billion to shareholders, which is almost half of the group's market cap. In terms of valuation, Imperial has a market cap of £16.5 billion and trades at 5.8 times forward earnings, compared with the 10-year average of 9.7. In terms of these results, I think, as we said at the outset, pretty much what we've come to expect. The volumes are falling pretty quickly, and it's not low single digits now. It's sort of the mid to high single digits. But again, that's a longer standing trend and something that I think everybody is expecting to continue. It still remains remarkable at how much the prices can be hiked to maintain the revenue growth, but clearly not something that can go on forever either. Some encouraging signs from the next generation products, and positive to see net debt below 2 times, although it's been broadly flat. It had been elevated, relative in recent years when they took on the blue e-cigarette acquisition from Reynolds a few years ago. I don't think there's going to be any re-rating happening. Obviously, the shares have been depressed for a long time, and institutional investors continue to move out of the stocks. But it is pumping out a huge amount of cash, which management are returning both in the form of pretty chunky dividends and share buybacks. I think the current yield is about 8.6% and around 2 times covered by free cash flow. So I can see a lot of investors, even if they don't see huge future ahead in the e-cigarettes, just buying this purely for the cash. Sam, what are your thoughts?
Pretty good, but I think the 7% drop in volumes is pretty high. And I know it's dropping anyway, but I think it's starting to look like the volumes are dropping more because of, I would put it down to non-combustibles taking market share. And I think it's probably a couple of percent higher, 2 or 3% higher than it otherwise would be. In terms of the valuation, 5.8 times earnings, but you can get British American Tobacco at 6.8, about the same dividend yield. And British American Tobacco has a much better non-combustibles business. So I've always, well, it's been for a while now, I've preferred British American Tobacco, and I've preferred the non-combustible side. But I think when you're starting to see these higher volume drop-offs, I think it's more important, especially when the difference in valuation is so low. I would just pay up for British American.
If you were taking British American out of the equation and you were just looking at Imperial as a company on its own, what would you see from an investor's point of view about buying those shares if they were looking at just the cash that it's sort of throwing off?
I think you could do pretty well. If I didn't know British American existed, I think I'd be pretty happy at that. Because although you got a 7% volume drop off, if it's returning 15% a year, you're going to get your money back before the volume goes to zero if you run the numbers. So yeah. I know they won't be able to hike prices in perpetuity.
Yeah.
But so far, it seems to be working. And I think your odds of getting your money back just through the dividends are pretty good, because I don't think cigarette sales will have dropped to zero in the next sort of 10 or 15 years.
Yeah, it's interesting because they've got the potentially new legislation coming through, but you think actually, even if that didn't happen, the trend is going that way without the legislation. It would just happen of its own accord, you feel.
I think that the volume drops are a bit higher than we're used to seeing.
Yeah.
I think that must be the non-combustibles.
Because when we did first start covering it, it would generally be sort of, I mean, this is just from memory, feel like 3 to 5% would kind of be where it would be sitting. 3 would be, that's, you know, from their point of view, a better outcome. And then 5 would be, you know, kind of, you know, you just see that happening as the check trend. But 7, I agree with you, that is higher than when we used to. But the market didn't seem to be that surprised. You know, I think the shares were broadly flat with these results.
But for me, it is slightly concerning if that continues, because you would want a good non-combustibles business that's going to grow to hopefully offset some of it. And I think British American by far has the better non-combustibles business.
Yeah. And then I suppose one of the other things that always comes up with Imperial is because it's that small, well, one of the smallest big tobacco companies, whether it's going to be acquired at any point. But I guess there's a lot of regulation that would be involved with that anyway. And just acquiring those those combustible brands that it does have. And I suppose that e-cigarette brand, it's very difficult to say how much it's actually worth. We know what they paid for it, but I think they'd be very lucky to get that sort of amount back for it.
We move on to Vodafone.
Yeah, so a stock that's been out of favour for a fair few years.
It has. So Vodafone, all these figures will be in euros, although they are listed on the FTSE 100. Have reported their half-year revenue, and it was 21.9 billion euros, up 3.2% on an organic basis, as annual price hikes came into effect and helped to offset falling customer numbers in some areas of the business. This growth figure strips out the impact of the disposals of Vantage Towers and the Hungary and Ghana businesses. Underlying cash profit was up 0.3% to 6.4 billion, growing at a slower pace than revenue due to significant increases in energy costs. Free cash outflows improved from 3.2 billion to 2 billion. So it's gone from a 3.2 billion outflow to a 2 billion outflow year on year. Net debt came in at 36.2 billion, an increase of 2.9 billion over the first half. Full year guidance has been maintained, and they expect to generate underlying cash profits of 13.3 billion. They reduced headcount by 2,700 in line with their plan to reduce 11,000 roles. A dividend of 4.5 cents has been announced in line with last year, and the shares fell 1.5% on the announcement. So Vodafone, as John mentioned before, is a business that has been out of favour for a while, and they have been making an effort to try and streamline the business and have more of a consumer focus. Part of the strategy has been the job cuts, which we've already mentioned. They merged the UK business with 3 UK. They've recently agreed the sale of the Spanish division. They've got rid of the Ghana and the Hungary divisions already. There's talk of getting rid of the Italian division, and they're hoping to focus on areas like Vodafone Business, which offer the most potential. The article I'm looking at here, it does give the example of Germany, which they've invested more than 20 billion euros in the market. And after that, service revenue and customer numbers are moving downwards.
Oh,
yeah, IT has been slow to adapt to new regulation, network performance lagged competitors, and a new management team in Germany is now in place. But all they've delivered so far is price hikes. There are some opportunities as well. So they've got the Vodacom subsidiary, which is quite a big player in some of the markets in Africa. So we have touched on it when we've looked at Airtel Africa previously. That subsidiary is targeting mid to high single-digit cash profit growth over the next few years, and Vodafone could benefit from that. But it is a small part of the business. It'd be of much more interest if you could get it on its own, I think, without the legacy business. In terms of valuation, business trades at a forward PE of 10.2, and that compares to a 10-year average of 21.6. And the prospective dividend yield is 8.9%, and that compares to a 10-year average of 6.5. I think these are really poor results. It's a continuation of the issues the business is having. So I don't really have an issue with that. And I know they've got a strategy in place and they are executing it. My main issue is that they've got 2 billion a year flowing out of this business and they're borrowing money to pay a dividend. I just think it's really, if the business is in such a poor state, I don't understand why management are, taking on so much debt just because they don't want to lose the income investors. I don't believe they're acting in the best interest of the business. I think it's really concerning. I know it's something that we do hark on about a lot, but I think this case is really concerning. So you've got, the underlying cash profit is 6.4 billion. Yes, it's maybe sort of 3 times underlying cash profits to debt. It's not in a range where it's obviously they're in serious trouble. But when you've got it on top of all these other issues the business is facing, I just think there must be a lot of ways the business would be better off using the money. I'd rather they sold, the Spanish and the Italian businesses and whatever else, and use that to just pay off some of the debt. And I just think it's really poor from management. I think given the state of the business, there should be a lot better things they can do than borrow money to pay a dividend. What are your thoughts, John?
Yeah, no, similarly, I can't think of many good things about the business or strong investment cases for it. I think it's very commoditized industry, and then it does also involve a lot of capital expenditure for the infrastructure side of it. And like you say, the debt levels aren't that high, but it doesn't say much about how the business is being run with the decisions with the dividends and borrowing to pay them and things. So yeah, I don't really like the sector. I know Airtel Africa aside, but I think that's a completely different investment case. And yeah, I wouldn't be looking to invest.
Which just, if you look at Airtel Africa, it's at a completely different stage of its life cycle to Vodafone.
Yeah,
Vodafone is in much more saturated markets. It's not really got much tailwinds going for it. It's got a lot of headwinds, if anything. Another thing I didn't mention is they've obviously had to spend quite a lot of money over the last few years upgrading the spectrum to 5G.
Yeah.
So yeah, just very capital intensive. Hopefully that, now a lot of that's in place. I've not heard anyone talking about 6G yet, so hopefully it will last a little while before they need to upgrade us all again. But yeah, it's just not a business I don't think ever be interested in. I'd maybe take a look at the African part if they span that subsidiary out. But
yeah, but
if they were to do that, if I was them, I'd try and load it up with as much of the debt as possible.
But I suppose one of the things, just going back to the sort of Airtel Africa, and of course it's operating in a completely different part of the world to the predominant Vodafone business, but it's maybe between 13, 14 times earnings, something like that. Whereas Vodafone, yes, it's cheaper, but it's not that much cheaper.
And one's shrinking whilst the other's growing a lot.
Absolutely.
Actually, it's not technically shrinking at the minute. It's actually up to 3%, but it has recently been shrinking. But
yeah.
Right, should we move on to Burberry?
Yeah, so covered quite a few times before on the show. It's a British fashion retailer. They had their half-year results out last week, with first half revenue up 7%, ignoring the effect of exchange rates, to £1.4 billion. And higher expenses contributed to an underlying operating profit rise of 1% to £223 million. So slower than the revenue growth. And all regional growth slowed in the second quarter, with the Americas the weakest performers. Outwear and leather goods saw total first half comparable sales growth of 21% and 8% respectively. There was a free cash outflow of £15 million compared to an £88 million inflow last year. That was partly driven by investment in product and distribution improvements. The timing of collections and increased inventory ahead of the festive trading season also had an effect. Current trading is being affected by a global slowdown in luxury demand. Burberry warned that if weakness continues, it would be unable to meet its full-year revenue targets, and operating profit would be at the lower end of their guidance in that scenario. An interim dividend of 18.3 pence was announced, which is up 11%, and shares were down 9% in early trading. In terms of valuation, Burberry has a market cap of £6.3 billion and trades at 14 times forward earnings, compared with a 10-year average of 20, and has a prospective dividend yield of 2.6%. I think Burberry is a decent company and it does have a relatively strong brand. But obviously this cyclicality we saw with LVMH, that things were slowing down. I think one of the problems with Burberry is that it's at the lower end of that sort of premium fashion. However, that being said, it's very popular in Asia, and that is a long-term growth market for it, which is a big positive. It doesn't trade at anywhere like the premium that LVMH trades at, which I think we both argue is a much better and much stronger company. I don't think Burberry's bad. I think it's going to be a tricky year for it. And price-wise, I think that's baked in. Its 10-year average is 20 and it's sort of 14 times at the moment. I don't think I would be rushing to buy shares, but I think in the long term, I would be optimistic about Burberry. Sam, what are your thoughts on these half-year results?
They're not terrible, but I think the last set of results we looked at for Burberry were quite good. And we'd had a couple of years where it hadn't performed and it actually recovered pretty well from COVID, but it's always been at quite a cheap valuation. And I think having followed it for a few years, I'm starting to get a bit of an idea why, because it's very stop-start. It's not one of these, it's not like one of these businesses like, for example, the Nestle, where, where it's consistently putting out these results. It might have a good quarter and then follow it with a poor one. Yeah, I don't think the revenue increase is terrible, but I think the operating profit growth of 1% is disappointing. I think you can't read too much into it, but the only sort of sliver of hope for me would be that the increasing the dividend by 11% does tell you what management think about the business, and they obviously think it's in quite a strong position going forward based on that. But we've just seen with Vodafone, management and dividends are not always done in the best interest of the business. So you do have to take them with a pinch of salt. I think it is a good business. I think it is a good brand, but I'd rather own LVMH. And these results, although LVMH was slowing down, it put up better results than this. And I think there's an element of you get what you pay for. I don't like the fact that with Burberry, you are basically only really getting the Burberry brand. Whereas with LVMH, you just have this umbrella of quality companies.
Okay, then on to, well, this might be probably will be the last time on the show, Hotel Chocolat.
Yes, so Hotel Chocolat, I think we've only actually covered it once before.
Yeah, I think that's right. Or
maybe twice.
Maybe
twice.
twice.
Yeah, I think we've covered it a couple of times. But yeah, the high street chocolate chain. I mean, we probably spent most of the time we covered it talking about the estate in St. Lucia that the shareholders paying for the management retreats, which is slightly questionable how useful that is. But never mind, it's Mars's problem now. So the Hotel Chocolat have agreed to sell to Mars, and the US confectionery giant will pay $534 million for the firm that Angus Thirlwell and Peter Harris set up in 1993. Hotel Chocolat said the deal would allow the brand to grow further and faster, including overseas. You do question how true that will be when you look at the success they've had overseas. Last year, they actually shut down They're 5 shops in the US. That costs $3.5 million, although it continues to sell online over there, focusing on its velvetizer hot chocolate maker. Earlier in the year, it announced a joint venture in Japan with Tokyo's Eat Creator Corporation to set up 21 Hotel Chocolat shops after its first deal fell apart. It previously had a partnership with Chris Horobin, the former boss of QVC Japan, to open stores in the country. However, that deal ended and resulted in Hotel Chocolat writing off nearly $22 million. They now hold a 20% stake in the joint venture with Eat Creator and will receive royalties from the deal. So they've not done amazingly well overseas. They did comment on that, and they said that building a brand overseas is not a short-term fix, but there's huge appeal for their products overseas. And Thilwell, who is one of the co-founders, well, he's also the chief executive, and he said, what we found more difficult and what was going to require more capital and more work was the operational elements of the business. So that includes manufacturing in countries, distribution, and behind-the-scenes element that customers don't really see. This tie-up with Mars is actually all about solving that for Hotel Chocolat. And then this article has mentioned that the company also owns an estate in St. Lucia, where it has a 140-acre farm that produces organic cocoa, and this is where the company operates the Rabo Hotel. They also have shops in Ireland and Gibraltar. So Farewell's also gone on to say in terms of the sale, we know our brand resonates with consumers overseas, but operational supply chain challenges have held us back. By partnering with Mars, we can grow our international presence much more quickly using their skills, expertise, and capabilities. Thirlwell and Harris both have a 27% stake in Hotel Chocolat. So Thirlwell, who will stay on as CEO, said he's going to invest 80% of the $144 million that he's going to make back into the company. Although he's probably going to be investing it back in and getting Mars shares instead, which I would argue is probably better. Mr. Harris is just going to retire. He said he'll invest some of his windfall in Hotel Chocolat, but hasn't disclosed how much. So yeah, it's more, we have covered the business twice before, listed on the AIM, market cap of 503 million now, although it wasn't a week ago. So the business had a year low of 100p, and then it was up 160% on the announcement of the takeover offer, and it's now up to 368p. Doesn't pay a dividend, doesn't have earnings after a really poor set of results. If you bought in recently, you've done very well, especially if you bought in at 101p with it now at 368 in less than a year. But most shareholders actually won't have done that well on this deal. So it's only really gone back to where it was in 2022. So it had an incredibly poor year or two. So I think it's quite a good deal for Mars, possibly, in that they're actually getting it for the price they could have just bought it for in the open market a year or two ago. Although if they'd offered then, they'd probably been rejected. But now it's quite a big premium. I think it'll be interesting to see what happens. I've never actually been in a Hotel Chocolat, but I do wonder if, they're going to start, you'd imagine they're going to start making use of a lot of the Mars offerings. I'm not saying you're going to go in and it's going to be full of Mars bars, but I'm not sure they're going to be producing all the chocolate themselves anymore either. But we'll see what happens with it. I don't really know how I feel about this. I was never that impressed when we covered it. So I think if you're a shareholder, although you've probably not done very well unless you bought it very recently, at least you've probably got most of your money back, if not made a bit of a profit. So yeah, it's not a company I probably would have invested in because I just don't really get it. I don't really see how it differentiates itself. I know the chocolates are nice, but there's a lot of other places that you can get that. But yeah, it'll be interesting to see what Mars do with the business going forward. What are your thoughts, John?
Yes, similar. I mean, Mars as a company is quite interesting because it's not publicly listed and it's still owned by the Mars family. But if you look at some of the brands that they have, it's fantastic. They've got M&Ms, they've got Bounty, they've got Snickers, they've got Orbits, they've got Extra, they've got Starburst, Dolmino, Snickers. They've
Mars
got
as well.
Yeah, well, yeah. I think that was a fairly obvious one. I thought didn't need saying, but then they've got their dog food and cat food business. They've got Pedigree Chum, Royal Canin, Whiskers.
Oh, are they Royal Canin?
Yeah. They've got an awful lot of brands. I think it's fantastic business. It's just can't buy shares in it, unfortunately.
No, not unless you're Mr. Harris.
Exactly. So I don't know. Yeah, as a shareholder, I guess you've had a bit of a rocky ride over the last few years, but
if you've held on though, you've probably done okay at least.
Yeah. Right. Shall we go on to BAE?
Yes, how are BAE doing? We've not done them for a while, I don't think.
No, we haven't. Well, I think they're doing quite a lot better than when we last covered them. I mean, if you just look at the news, with all of the political instability around the world, that generally benefits BAE. It's the defence group. They had a trading statement out last week with the group on track to meet its full year guidance. This includes sales and underlying operating profit growth of between 5 and 7% and 6 and 8% respectively. Full year free cash flow is also expected to be in excess of £1.8 billion. The group secured about £10 billion of order intake since the last half year mark, taking the year to date total of up to around £30 billion. BAE pointed out that most of the major defence programmes are long cycle, meaning that the contracts secured now will be executed over many years, providing them with longer term visibility over their revenue growth. The regulatory process surrounding BAE's $5.5 billion acquisition of Ball Aerospace is progressing well, and the group's targeting a completion date in the first half of 2024. Through dividends and share buybacks, BAE expects to return around £1.4 billion of cash to shareholders this year, and the shares were broadly flat following the announcement. In terms of valuation, BAE has a market cap of £32 billion and trades at 16.5 times forward earnings, compared with a 10-year average of 12.5, and as a prospective dividend yield of around 3%. I thought this statement was pretty good, certainly with what we've got used to with BAE. It's usually more muted than this. I think this is BAE doing really well. It's largely down to the global instability and the focus of many governments on security, and that's being increased or at least maintained at the very least. And you'd expect, without a crystal ball, that to continue into the future, or into the near future at least. I think it's interesting that the group's investing and growing more in terms of the electronic systems, cyber and intelligence, and the platforms and services businesses. But still, the air and maritime are where most of the revenue comes from. I think my main concern with it would be that whilst clearly a lot of expertise are required and there's quite a high barrier to entry in the industry, it is very capital intensive. And whilst they're in a better shape now, and I suppose we're entering sort of good times for BAE, I don't think there's huge amounts of growth, and they do need to spend an awful lot of money, and they were laden with an awful lot of debt, which is now that they have improved the health of the business from that perspective. But I think it's, very, very difficult industry to be in. I don't think it's one that I'd really like. I think there are a lot of other better companies around. Sam, what are your thoughts on these results and BAE as a company?
Good results, and probably the best we've seen since we started doing the show for BAE. But I do think now they've had a very good year in terms of the share performance. The order book's looking very healthy. Mentioned the global instability we've got. This is a very cyclical business, and I think a lot of what's going on, hopefully we're quite near the top of BAE cycle. And I don't mean that in terms of like a knock on BAE, but obviously if orders were to get even better, it's not really a good thing, is it? So you'd hope, although we've got a lot of instability at the minute, it's not going to get any worse. So I think given it possibly is at the top of the cycle or near the top, even if it's not, I think 16.5 times forward PE is pretty expensive.
Yeah.
It is a good business. I know you can, you've got that order book, so you can it's quite a predictable business as well, but it's just not a business I'd want to buy anyway. But I don't think I'd want to buy it at the top of the current, at the top of the cycle. And I do think it's quite expensive for what it actually is and the growth you'll probably get from it.
Yeah, and I think it's interesting as well, the areas that they're expanding and obviously investing a lot of money into, which is more of the cybersecurity. And compared with making the jets and the warships, whether there's actually a lot more competition there and it's going to be potentially more difficult. I know you might say that the margins could be better on some of that stuff, but they're not a ginormous company, and you wonder whether it's going to be more tricky for them in the future on that as they pursue that further.
Yeah, be interesting to follow, but it's just I don't think it's ever a business I'd be interested in. I don't think.
No, that's fair enough. Okay, then on to our US company of the week and one that you do own.
Yes, so PayPal have come out with their third quarter results, and total payment volumes increased 13% to $387.7 billion, ignoring exchange rate impacts. This drove 9% revenue growth to $7.4 billion, ahead of market forecasts, with strong performance in other value-added services. Underlying operating profit rose 8% to $1.6 billion as a result of the higher revenue. The associated margin fell slightly to 22.2%, as lower margin unbranded payment volumes continue to grow significantly faster than the rest of the business, but the majority of this negative impact was offset by cost-saving measures. Free cash flow improved from 1.6 to 1.9 billion, excluding the impact of buy now, pay later loans. Net cash stood at 907 million, up from 451 million. The group completed 1.4 billion of share buybacks in the quarter, with 5 billion targeted for the year as a whole, and that's on a market cap of 61 billion. So that's a very healthy 8.2% return. And because it's a buyback, you don't have to pay any tax on it. Whereas if it was a dividend from the US, you would. So unless it was in a SIP. But yeah, so that's a pretty healthy return, especially for a business that's still growing. And the shares rose 7.39% following the announcement. So in terms of valuation, business trades at a forward PE of 9.4, and that compares to an average since listing in 2015 of 30.1. The prospective dividend yield is not 0%. However, as mentioned, they are buying back shares at about 8.2% a year. So as mentioned, I am a shareholder. I'm a very happy shareholder with this. I think the market's massively overreacted. The way the price has dropped, you'd think it's a business that's dying, and revenue's up 9% on 13% volume growth. Yes, it's shifting towards lower volume products, but if you can carry on increasing revenue and profits, even if the margin's going down a bit, if the profits are, still going up, I don't really mind where they come from. And it is just so incredibly cheap for what I would consider to be an incredibly high quality business. So I've been a shareholder for how long? Maybe 6 to 7 months now. Very happy with how it's doing. Not the share price as much, but I have actually just topped up on the back of these results because I was down about 25% on my original position. So I have topped up a bit on it. But yeah, I'm very happy with how the business is performing in these results. John, what do you think as an unbiased observer?
Unbiased. I mean, the results seem pretty good. I guess it's what's the future of the business? You obviously think it does have a future, perhaps not the startling growth that it used to deliver. And I know we've talked about it before, but Apple and Google coming into it in terms of the payments, and that we both, well, I've got an iPhone and do use Apple Pay, sort of as pretty much, I don't know, 95% of purchases. I think you same with Google.
I am, but you can. I think I use PayPal as much as possible because I've mentioned before, it gives you that extra layer of protection on my debit card.
Okay, yeah.
Because but if it's something big, so for example, I bought a camera this month. I bought that on my credit card, which was Google Pay. But like my everyday spending, because I've got the Chase account with a 1% cash back. But I still want the protection, so I use PayPal to get that extra layer of protection on top. So I actually do use it a lot.
Okay, but I suppose that is one of the more long-term concerns for the business. I'm kind of on the fence with it, really. I can see your argument, and I can see as well at the valuation now compared with historically. I probably wouldn't be brave enough to buy shares, but I can see why you might, and why you might have said it's a quality business. I've wanted it for a long time, and now it's actually at a decent price. So yeah, probably not for me at the moment, but very interested to follow it, or to continue to follow it.
It's not a business that I would have paid 50 times earnings for, or 80 times earnings, or whatever it was at the height of the pandemic. But I think at 10 times earnings with an 8% yield, it's basically priced like a tobacco company. I don't think it's an exaggeration to say that. And I think, again, you could argue that like a tobacco company, it may be going into terminal decline. But the amount of cash it's churning out,
Yeah.
I think between now and whenever that is, I know it's a technology company, so in theory the drop-off could be a lot sharper, but given it's still actually growing, I'm quite happy to take the chance, but we'll see. We'll see if I'm wrong.
Yeah, very good. So of the companies this week, which one would you go for?
So my favourite would be PayPal.
Okay.
And it's
then
the one I have topped up on. And then
bottom of the list?
Bottom, probably Vodafone. I don't particularly like BAE either, but I think BAE has less issues than Vodafone has. At least it seems to be getting the business in a bit of a better state. And it's not doing anything that I would consider to be just really... Well, there's nothing immediately obvious from the management that they're not behaving in the best interest of the business and the shareholders, whereas I think with Vodafone, I do really dislike borrowing money to pay dividends, but I think the circumstances of Vodafone doing it are just quite silly.
Yeah.
What about you?
If it were last week, I'd have liked Hotel Chocolat. That would have been very nice. But this week, if Mars was available, that would be my first choice. I would probably go for Burberry, I think. Longer term. Yeah. I don't love any of the businesses this week. And yeah, Vodafone would be the last on the list for sure.
All right.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.